Good day, ladies and gentlemen, and welcome to our class on the basics of Japanese candlesticks. This is the perfect class for a novice trader. We're going to be going over candlestick patterns, candlestick charts, and reading candlesticks, as well as incorporating them into your trading, but for the beginner, the experienced trader. Now, I would appreciate it greatly if you would click on the subscribe button down below and subscribe to my YouTube channel. I don't advertise anything. I don't sell anything. I'm not part of any organization. I don't ask you to sign up for anything. I just ask you to watch my videos. So please just click on the subscribe button down below. And I promise you, we won't bother you with anything. You'll just get, when you go to YouTube, you'll see what's new on my channel. So let's get ready and move on to learning all about candlesticks. Now keep in mind, this is a basics course. You can take all my other classes on learning how to use these in different strategies, how to use my indecision candle trading strategy, how to use my reverse trading strategy. But you first have to understand the basics. Now, every trader, whether you're a novice or an experienced trader, wants to use Japanese candlesticks. They are the cool word for trading and for charting today. Now, Japanese candlesticks have been around since the 17th century, but it wasn't until we started online trading and got these modern Java charts and HTML charts where we were able to actually use candlesticks to their best advantage that they became so popular. Now, everybody wants to trade from candlesticks. And candlesticks are a charting method, they're an analysis method, and they're a trading method. But you can't just start from the middle or the end. You have to know the basics. You have to understand what candlesticks are telling you and what we call, and what we're going to look at today is what's called pattern recognition. Because when I talk to you and say, when price action does that, and you see a bearish or bullish engulfing candle or position, you should be looking to do that. Or when you see a doji appear directly on a line of support and resistance. But if you don't know what a doji is, you don't know what you're looking for. Now, how you're going to combine it in your trading is a completely different story. How you're going to use it to interpret price action is another story. But you have to start from the basics. Now, if you keep in mind that a time frame on a chart gives you all information that is reflected in the price, because the only things that we as traders have is the open, the high, the low, the close, and sometimes volume. So no matter what charting method you're looking at, no matter what oscillator indicator you're looking at, they all start with those numbers. Now, they can apply all different types of mathematical calculations and derivatives and everything in between. But you always have, everything is based on the same pieces of information. Now, each candlestick on a chart represents a data set for the complete price action during that selected time period. So if you're looking at a 15-minute chart, that one candle shows you the open, the close, the high, and the low for that 15-minute period. If you're looking at a 1 hour chart, it shows you the open, the high, the low, and the close for that 1 hour chart. So if you were going to jump from a 1 hour chart and want to see more information and go to your 15-minute chart, those four candles on your 15-minute chart are what made up that 1 hour. But there's a big difference, because that 1 hour showed you the open all the way up here, the close all the way down here, and the low way down there. But it might have all happened in the first 15 minutes, and then it could have been docile and no volatility. Or it could have hit the high for that 1 hour period in the last 15 minutes and hit the low in the first 15 minutes. So when you break it down, you see more detail. Now, so every candle consists of the open, which is a line across, the close, which is a line across, a dot above and below for the high and the low, and then we connect the dots to the lines, and these are called wicks or shadows. And then when we connect the lines together, that's the body of the candle. A green candle means that the price moved up from the open to the close. It stepped up. When we have a red candle, it tells us that the open was higher than the close, so it closed lower in this time frame. The wicks show you how far the price was pushed by the bulls or the bears in that time frame. Now, I've got to stop and give you one piece of information here. And that is that we refer to candlesticks in greens and reds today. But technically, you could do, at some websites, some online trading sites, use their corporate colors. And you can change them all you want. But you'll see that one candle's gold and one candle's blue, say, hypothetically. Well, as long as you know which is the bullish and which is the bearish, it's perfectly fine. It doesn't change anything. And often you see things referred to black and white candles. Now, when I started trading in the early 70s, and we were sitting in the pits and we had to graph and chart by hand, most of us used bar charts. It gave us the same information, and it was a lot faster and easier to put it on your chart. And if you're sitting there hand drawing charts and you're drawing for 4 or 5 assets, and you're drawing every 15 minutes or every half hour, every hour, continually over, you want to do them as quickly as you can. So when we refer to white candles, that's because when we drew the candle on our graph paper and we only had a pencil, we just didn't use the side of the pencil to fill in that body of the candle. So the white candle was a bullish session. And if it was a bearish session, in other words, the close was lower than the open, we'd use the side of the pencil and fill it in. So, our pencils were black. So everything became to black and white. And the reason this is important is a lot of literature you read will discuss or mention black and white candles. Or there's positions that are called 3 black crows, 3 white soldiers. And we're not going to go back and change the names of them now to 3 green this and 3 green, because they're the names that have been applied for a long, long, long time. Now, as I said earlier, a bar chart contains the same exact information as a candlestick chart. And bar charts actually even give us the same general patterns. Now, the thing is about candles is everybody seems to like them because they think they can look at they're pretty to look at in a chart, and they think that their eye can instantly see all these reds and greens and make decisions. Well, the fact is, candles are not really about how much red or how much green you're looking at. It's about a couple things. It's about the size and the shape of the candle and the position of the current candle in relationship to the previous candles. Doesn't matter whether you see lots of green. Lots of green doesn't mean the price is going to continue to go up. Lots of red doesn't mean the price is going to continue to go down. Now, each candle tells you the story about the battle in that time segment. So close your eyes and imagine a tug of war. And I told you there was 6 guys from the high school soccer team on this side and 6 guys from the high school football team on that side. And they had, excuse me, and they had the rope strung across the creek. And the soccer players were pulling as hard as they want, and the football players were pulling as hard as they want. Now, the position of those soccer players on the banks would be where your open is. If at the end of that, say, 15-minute period, the football players had pulled the soccer players farther into the bank, so the first player actually has his feet wet, that's your close. And the candle would then be black because white, because the football players were pulling in the soccer players who were the bears. But in that 15-minute interim, say those soccer players yanked as hard as they could when it first opened and pulled the football players into the river, but the football players pulled back and ended up the segment with the soccer players, some of them in the river. So the maximum that rope had been pulled in each direction are your shadows or your tails on your candle. So if you were the guy sitting there watching this soccer match, or there's a tug of war with the soccer and the football player, and say you were announcing it over the radio, what would you be saying? Well, you'd be saying, Well, the soccer players had some momentum in the beginning, but they lost the momentum, and the football players tugged back. They got some incentive, they got some momentum, and they ended up pulling the soccer players into the river. Well, imagine putting that to prices. The Bulls, the Bears, and the Wicks, same story. So, example number one is where the football players ended up winning. Example number two is where the soccer players ended up stronger at the end of that period. But you can see exactly how far that rope moved and how far they pulled. And each one of these are the 6 possible combinations. So imagine the long white wicks indicate that the Bulls controlled the ball most of the game if you're talking about a football game. Okay, number 2, the long black candle indicates that the Bears controlled the ball most of the time. You can tell easy to understand stories by looking at the candles and relating to them in ways that you are swayed by what you're visually seeing. What you need to do is look at those wicks, look at the bodies. Okay, if you have a long wick on the football player side, that tells you those football players really gathered some momentum, but they couldn't hold on to it. It's telling you a story. Now, hypothetically, if you were to see a candle that had no wicks on either side, what would that kind of tell you? It would tell you that the football players had pulled as hard as they can, they pulled the entire session, and continually through that session, they pulled and pulled and pulled, and they ended that session dominating because what happened? They ended up closing at the highest point because they had been pulling the whole time. The Bears never got a wick off because they were being pulled into the same time. So there was never a low or a high because the low was same as the close. And then the bodies. The bodies tell you how much activity there was in that session. Because you could have had that session that opened up and didn't move at all. You know, say the girls came by and all the boys stopped looking at the girls and nobody was really pulling. There was no activity. But you could also have a very long body that told you there was lots of activity in that period. So we always have to look at long shadows, short shadows, which the way they go, and what the candle color is. Now, there's certain specific candles that tell us something. Now, this is called pattern recognition. If you watch my other videos on candlesticks, I'm going to tell you that pattern recognition is a waste of your time. And it is. Memorizing these things, memorizing what you're supposed to do, is a waste of your time because trading isn't about doing some rules, some formula. Trading is about being able to read what is happening in the markets and making intelligent decisions using some of these known patterns. So, like I mentioned earlier, we have MARUBOZU. That's the one that has no wicks or shadows. So, if it was green or black or white, it meant the Bulls or the football players had pulled continuously during that period and closed at the highest amount. If it's red or black, it's the opposite. The soccer players did. Then we have what's called spinning tops. These are candles with long upper shadows, long lower shadows, and a relatively small body. They look exactly what they are. That means there was lots of activity in the market, but the buyers and sellers, the Bulls and Bears, couldn't make up their mind. They ended up pretty much where they started. And then we have the most famous of them all, and that's the DOJI. The DOJI is a candle with relatively no body. That means the open and close were virtually the same. That means that neither Bulls or Bears, buyers or sellers, had any indication what was going on. A lot of them were just sitting on the sideline. And you can have dojis with very long shadows, but the most telling doji is the one that has equal levels all the way around, tails in each direction, and has no body. Now, the rule of thumb years ago, before we really had Forex trading online and we had all this CFD trading, was that the open and the close had to be exactly the same. and that would give you the simple line across. Okay. And that was a pretty accurate indication of something was happening in the markets. But when we started trading online trading, we started trading Forex in pips, 4 digits to the right. It's very rare that the euro is going to open at 116.01247 and close at 116.01247. It's probably going to open at 0.362415 and close at 0.136244. 1/1000th of a point difference. Okay. Well, that still gives you this fine, tiny little body. So that's considered today acceptable for doji. And then, of course, we have dojis with long upper and lower wicks. That tells you somebody, for some reason, was able to pull the market up, but they couldn't withstand it whatsoever. But maybe somebody jumped out and was able to sell or buy at a big move. So the relevance of a doji depends on the preceding trend or the preceding candlesticks. After an advance or a long white candle, a doji signals that the buying pressure is starting to weaken. After a decline and long black candle or doji signals that selling pressure is starting to diminish and where it is in relationship to the trend line. So applying doji candlesticks is a good trick is to look out for a doji near the edge of a price channel, near the edge of a trend line, or in a chart pattern like a triangle. Okay. Looking at where it is and what price is trying to tell you, because dojis appear quite often. And if you paid all this attention to like doji here, you spend your time trying to evaluate, but they don't tell you. This doji appeared directly on the trend line. So it is a valuable piece of information. But that's what it is. It's information. And then we have what we call long-legged dojis. That tells you the market was extremely active, but in the end, the buyers and sellers, and it usually has very low volume. And that's why it's a few traders, or not few, but a few big traders are able to push it up, push it down, but there's no conviction in the market. Then we have what we call gravestone and dragonfly dojis, all kinds of shapes and sizes. And that's why being able to look at the candle on your chart, you don't have to memorize all this. I can't remember all the names of them. I just know what I'm looking at my chart, and I see something like this. I understand what it's trying to tell me. So remember, understanding is very important. Now that you have the basics of what candlesticks indicate with their bodies and wicks, let's cut our teeth on some simple, uncomplicated patterns. And remember, position of the candlestick is very important. So we have things like star position. That means it looks like it's appearing as a star next to the previous candle. Okay. In a stock market, it's usually a gap. And then we have shooting stars and we have inverted hammers, because that's exactly what they look like. Believe me, do not memorize these. Don't go through them. And I'll show you in a minute, but all of these have rules. Don't learn these rules. Don't waste your time. Learn to just understand what that candle is trying to tell you in relationship to the trend and price action. So we talked about a HARAMI before. No, we didn't. We talked about MARUBOZU before. HARAMI is an interesting candlestick pattern. It means the newest candlestick appears fully contained within the body of the previous candle, and most time the opposite color. In Japanese, HARAMI means pregnant. So it looks like a pregnant woman. Here's the body, and here's the candle contained within her body. Okay. It tells us something, but don't memorize what it's trying to tell you. Just understand its name, because a HARAMI is one of the most common candlestick patterns you'll come across. So it's important to recognize it, to understand what it means, and to understand its limitations. A HARAMI is a 2-session reversal pattern. So as you can see here, the body of the small black candle is completely within the confines of the previous white candle. But I'll be blunt with you, a HARAMI doesn't always live up to its hype. While it is touted as a reversal indicator, you might find yourself disappointed on its reliability. So don't memorize these things. Be aware, use them in your price action analysis. Now, we've talked about building a candlestick chart, understanding and reading the candle. We've talked about the shape and sizes of the formation, the position. We've talked about the doji, the harami, the tops, the shadow, the bulls versus the bears, the hanging man and the hammers. And we're just scratching the surface. But now it's time to learn about multiple candlestick patterns. I told you it's a lot more than just reds and greens on a chart. Now, this little graph or this little chart up here, I didn't make up. I actually took it off of one of the websites. And I don't call them lonesome candles, 2 for tango or 3 to musketeer. They're singles, doubles, and triples. It's how many candles are used to make up those patterns. So we've talked about the MARUBOZU, the spinning top, the doji, the hamming. Those are single standalone candles. Now we talk about the combination I mentioned earlier, bullish engulfing and bearish engulfing, bullish tweezers and bearish tweezers. Bullish engulfing and bearish engulfing are the most popular, most well-known, and most reliable. They tell you when the current trend is about to reverse. And then we go on to multiple candles, morning stars, evening stars, 3 white soldiers. Remember I told you white and green, but we didn't change the name. 3 black crows are still 3 black crows. 3 inside up and 3 inside down. To be honest with you, I don't pay any attention to these because I don't even see them, because these are combination of candles. By the time you have the combination of 3 candles, I've already seen what price is trying to tell me. But there are 18 overall popular important shapes. Now, you can go anywhere on the internet and pull up this chart. It's not quite unique. And just pull up Japanese candlesticks and popular patterns, and you'll get the same 18. It's not my list. It's a standardized list. Okay. You should be able to look at them and recognize them quickly, not memorize their name, and understand what the market or price action is trying to tell you. But in total, there's actually 32 shapes. Now you're going to see charts like this all over the place. Please don't get involved in them. Okay. The chart is very accurate. The name is very accurate. But this tries to give you what I told you earlier, the rules about what you're supposed to do. Okay. Don't get involved in what you're supposed to do. Understand the pattern and then understand how to look at it in relationship to price action. Okay. But these are the ones you should be aware of, but please don't say this is a reversal pattern, because less than 50% of the time is anything a reversal pattern. But this is the only place that you can start. You need to get the basics. Now, we have our next candlestick, which is candlestick analysis, which we'll start analyzing in our next webinar, price action and candlesticks to look at what's happening in the real live world as things are moving across your screen, as opposed to memorizing charts with patterns. So please join us for that next webinar. So thank you very much. Thank you for coming to Everything Financial, where we try to make complex concepts easy for you to understand.